Yesterday, the U.S. Federal Reserve cut interest rates 50 basis points, taking the Fed funds rate down from 5.5% to 5%. And this is a very significant event because it means now that the globe is in a loosening cycle. The Federal Reserve has cut rates 0.5 percentage point, and this basically allows other central banks around the world to start cutting interest rates and continue to do so as the global economy appears to be slowing. Specifically in the U.S., the Federal Reserve cut rates believing that the economy now needs help. And as a result, we're likely to see many more rate cuts to come over the next 1 to 2 years. Now, if we look at the bond market, the U.S. Federal Reserve controls short-term interest rates, meaning the overnight lending rate between banks is controlled by the Federal Reserve. However, with the bond market is set by traders, investors, etc., who every day buy and sell bonds and determine what the interest rate is for any specific period. So the Fed only controls the short term, the markets control the longer term. However, the 2-year bond is a very important indicator. Jeff Gundlach at Double Line Capital, who's one of the largest bond fund or fixed income managers in the world, always states how important it is to look at the 2-year bond. Now, the 2-year bond currently, as of yesterday, was at 3.6%. The Fed funds rate was at 5.5%. This is a difference of 190 basis points. And I read an article the other day. I didn't write anything down, but the author indicated this is one of the largest discrepancies or differences between the Fed funds rate and the 2-year bond rate, 190 basis points. And what it says is effectively that the Federal Reserve is behind the curve, meaning the Fed now has to catch up to what the bond market has been saying. So the 2-year bond has rallied dramatically, taking yields down to 3.6%. And in order for the Fed to get a normalized yield curve, and a normalized yield curve is when short-term rates are lower than longer-term rates, the Fed has to cut at least 2 full percentage points to normalize the curve. So it looks like we're in for, as I mentioned, a lot of interest rate cuts going forward. And what this means is that effectively central banks around the world are cutting interest rates to devalue their currency in order to stimulate loan growth to reflate economies. But the one problem now is that inflation that's been coming down isn't necessarily under control or finished with. So the fact that the central banks are making money cheaper at a time where inflation is still effectively in the system raises some real problems. So what this effectively means for investors going forward, for stocks, it's quite likely stocks may rally initially on the euphoria of interest rate cuts. However, the reason interest rate cuts are occurring, as I mentioned, is because the economy is weakening. And with a weakening economy, it's quite likely we will see earnings numbers for the U.S. economy and for stocks coming down. So the stock market could be vulnerable over the next 3 to 6 months. For precious metals and commodities, it's quite bullish. As I mentioned, the currencies of the world are going to be devalued by lower interest rates. And as a result, hard assets could do very, very well. So for investors going forward, it's important to remember we have just started a interest rate cycle, lowering the cost of money. And as a result, we will see, I think, very volatile markets and a lot of uncertainty going forward. But as I said, I do expect the precious metals to continue to rally on the continued inflation fears and the geopolitical problems that are occurring right now in the world.